Hi everyone, I'm Jeff Hirsch. I'm here with Carley Garner. She's at dcarleytrading.com. Very experienced futures options trading type person, and you've got a way to trade futures like stocks, because futures are a little bit difficult for stock people sometimes.
Futures are different. There are plenty of advantages to trading futures. They're efficient. They're more efficient than like ETFs. If you wanted to trade gold and you tried trading a gold ETF, there's all kinds of inefficiencies and hidden costs, those sorts of things. Futures are more efficient, but the problem is they're also leveraged, and they don't pay dividends, and so people are turned off by that because you have unlimited risk, no dividends, and they're risky if you're not managing it. Yeah, you have to have a margin account, but there is a way to conform the futures position into something that mimics stocks. So, for example, something that collects income and also has limited downside risk. And so, what we recommend for that sort of a strategy is to go long a futures contract and then buy a put option.
This could be, pork belly futures.
Well, pork bellies were delisted, but yeah, in theory, that's right. Yeah, it could be just about anything. The key is, though,
it could be live cattle or. Right. But you're talking more doing it with stock index futures.
No, this could be, actually we do this more with commodities like grains. This strategy works really well in commodities. They have low margins and the options aren't super high priced. Right. If you start getting to the expensive markets, like for example crude oil, it doesn't work so well in crude oil for whatever reason. The futures are too volatile and the option hedges don't work as well. But markets like grains and meats, it works really well.
So the softs.
Yes. So
not
softs works
not the energy or metals.
Or agricultural commodities. It tends to work a little better. It can work really well in treasury futures like the 10-year note, that sort of thing. But the idea is you want to limit your risk by purchasing a put underneath the market. We call it catastrophic insurance. We don't want to buy an expensive put. We don't want to buy a put that's right at the money. We're buying something well underneath because we think the market's going up, but just in case we're dead wrong, we don't want to be caught in the black swan kind of thing that ruins your month or your year.
So buy a put well below the market.
Right. And then sell a call option near the money or maybe a little out of the money. But the idea with the call option, you want to collect as much premium as you possibly can. So that way you're playing the upside direction with income. That income, the money that you collect on the call option.
First, you're long the future, though.
Sure. Yes, absolutely. You're long the future.
Long the future.
Long future. Then you sell a near the money call, and then you buy a really cheap, deep out of the money put. And really, what it turns your position into is something that can make money if the market goes up, down, or sideways. Because the money you collect for the short call buffers your futures risk on the downside. So let's just say hypothetically in corn, you buy corn at $3.50, you sell a call option for 20 cents. If the market trades 20 cents lower, the money that you collect on your call option buffers that. So you actually end up breaking even at expiration, even though you're 20 cents wrong. And then if you have a put under there, let's say you're 40 cents wrong, but your put kicks in at 30 cents, you might only lose 10, 15 cents on the trade. So you basically had income to give yourself the ability to make money when the market goes sideways, which is exactly what dividends do for stockholders. And then you also have limited risk, so if you're dead wrong and the bottom falls out and core goes to zero, at least you have a floor there.
And on the upside?
So your upside's limited. The upside's limited to basically what you collect in the premium on your call, plus or minus any difference between the futures entry and the strike price, but we'll just call it generally speaking, whatever you collect for your call is basically what you're looking to make. But you don't have to be really right to make that money. You only have to be not wrong. So if the market's exactly where it was when you entered the trade at expiration, you get to keep all the premium that you collected on the call. If it's higher, you still keep all the premium because the premium is extrinsic value. So as the futures market goes up, your option is gaining in intrinsic value, it's losing in extrinsic value, and your futures position's offsetting that. So it's a little tricky.
The safe zone is just the premium in between the strike and the put, and then the danger zone is down below there, but that's limited.
Exactly. And if the market goes up to the moon, it's kind of sad because your profit potential is limited, but it doesn't matter. You made money at no stress.
And you never get it. Thanks very much, Carley. Thanks everyone for joining us.